This video today is a market update. So, what's been happening with the stock market? Been a little while since the last update. Let's jump into it. So, we're starting to experience a bit of a pullback. This is after having a monstrous run. This run came after the dip, the tariff dip, where everybody lost their hair. And went a little wild. Went a little crazy. All right. So, right now, the market's pulling back. What should we think? First of all, I want to say when the market pulls back, then the negative news follows. Let's repeat that. When the market pulls back, the negative news from the media outlets follows. It's not the other way around. Everyone thinks when they just get into investing for the first time, that's the other way around, all right? So they're always looking at the news, like, what's your thoughts on this or that, and they're studying it, you know. Yeah, they may have heard things like, Warren Buffett in his past used to read the newspaper from start to finish. All right, maybe back then, the newspapers, they were helpful somehow. I don't know. I never really read newspapers much. Today, we live in a completely different world, a social media driven world, a fear mongering driven world. It's about selling clicks, right? So if something comes down, like the stock market comes down, people get a little bit fearful. Why? Because they just saw their money disappear in front of their eyes. Obviously, that's a scary thing, or could be scary to some people without the right knowledge, because they're thinking, hey, it took me this long to make this money. Oh shit, I've now lost it. Lost it. That's in quotation marks. Obviously, it's going to come back. If they're invested in actual strong assets, it's going to come back. So they're a little bit fearful anyway. They're a little bit fearful. So what are they likely to do? They're likely to click on fear mongering news articles. So that's the business model from the media outlets. And we all know this stuff. We all know this stuff. They're in the business to get clicks. When we click, we see their ads and all that stuff. That's how they make money. So when the market pulls back, that's a fear full events, or it's a little bit more fearful to some. That means they can capitalize, the media outlets can capitalize on this and make money. That's what they're in. They're not in it to help us. You think they're really that nice? I say, hey, by the way, be careful of this thing that's going to affect your investments. Um, you know, they never give you actual financial advice in these things saying, hey, you should probably sell. They can't say that, right? They can't say that. Even if you look at some other people who are, let's say they're influencers or maybe above an influence where they're like an economist or, you go down the list. These type of people often are the same as the media outlets. They're just, blabbering on social media saying all these doomsday events. So then you sign up to their course or their newsletter or their consulting service, all of that, because fear sells really, really well. Fear sells really, really well. Like, it's funny, like, with the tariff stuff, so many people came out of the woodwork saying, this is the event, this is the Great Depression, all this is about to happen. Then what happened? A a few months later, the stock market's at all-time high. Like right now, we're at all-time highs. There's nothing to be scared of. But what I want to prepare you for is it's the start of maybe potentially a correction. So get ready for the news articles to come and do nothing, please. Please sit on your hands and do nothing and potentially think about buying the dip. Now, this is very, very optimistic. I want to tell you, like, wrap it up in one sentence. This is the easiest dip to buy of all time. This is so goddamn easy to buy this dip. This dip is absolutely a no-brainer, in my opinion. Why? Let's just look at the all-time high before the tariff correction and draw in a line like that. All right? Often, we've said it a million times, the best time to buy is when you break out to all-time high. Why? Because we draw the smiley face. Why do we draw the smiley face? Because everyone's happy because everyone's made a profit. When everybody's made a profit, what are they likely to do? They're likely to speak and communicate to everyone else, hey, I've made money on this thing. Maybe you should invest some too or invest even more. This is supposed to be a speech bubble if you're trying to figure out what that thing is. Kind of looks like something else. Anyway, Best time to buy is at all-time high. Second best time is when you get the pullback. But you want to buy on the all-time high. Why? Because uh, 30% of the time, the market just runs and it doesn't pull back. 70% of the time, the market will pull back. That's a sign of a healthy market, a normal, healthy market. A crazy market, which you get like 30% of the time, it's less likely you get that. It's like a rocket ship straight to the moon. It just goes and it just runs. And when that happens, when you don't get that pullback, you should actually be thinking, oh, okay, these gains that are going to come in the next few weeks and few months are probably going to be outlier gains where you're probably going to make even more than usual. Okay. So 70% of the time, the market pulls back. Right now, we're pulling back to the previous all-time high. So it's a standard healthy market. This is what standard healthy markets do. Meaning, don't you even think about listening to the negative news articles. If you do, come tell me so I can give you one of them, all right? I want to give you one of them. Anyway, think about the tariff correction. Everybody lost their minds for nothing. Think about the COVID correction. Everybody lost their minds for nothing. Change that with everything. It's the same thing, okay? Now, I've drawn in this green line. As we know, these lines, they're just guiding lines. They're not that significant. I wish I could increase the pixels. Like this is a 4-pixel line. That's the max on TradingView. I wish I could increase it to like 10 or 20, okay? Because they're just to guide us, all right? They're just to guide us. You can't, like, I see these guys, they got these 1-pixel lines. Dude, you reckon the market's going to reverse right on your little 1 pixel? Lad, she doesn't make any sense, brother. It doesn't make any sense. Okay? So what I'm going to do is I'm going to thicken this line by drawing a little squiggly line above the green line. There we go, okay? Now, here's where I'm going to teach you something new. I've just kind of thought about it, okay? I'm pretty sure this is a unique thought when it comes to the world of charting. I haven't heard this from anyone else, I believe. I'm pretty sure this is my thought. Maybe not. Who knows? Anyway, if it is someone, just post a comment down below. I'll give them credit next time. All right, so we've drawn the red squiggly line above that. Now, what do I visualize this as? I visualize this as, I used to say it's like a concrete block. Like it's a support concrete block. So the market is like a tennis ball and it should bounce on it. If it doesn't bounce and it splatters on the concrete, then and it stays there, that's a sign that's a rotten egg and the market's going to reverse. Okay, and these are just little hints, giving us little clues of what the market could do short term. These things aren't really that important, but they just give us clues, right? Now, roughly in this region, the market, I believe, 70% chance pulls back into it and then goes higher. Okay, that's what the market likes to do, especially when you break out to all-time high. Now, exactly where it's going to end, I got no idea. That's why I think you should just dollar cost. Okay. Now, in the case that it does go further down, what we should be thinking is this is like a trampoline. The further it goes down, the cheaper it is becoming. It's like pushing down into the fabric of a trampoline. So then what happens? It's physics, right? Boom! She skyrockets higher and faster. You could have said the same thing like with this, okay? There was like a support level in here. We held at it and we went down, 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 down with all the fear about the tariffs. It's a trampoline. This is a trampoline. Boom! We're back up. Now, at all-time highs, it's a stronger trampoline, okay? At all-time highs, this is a stronger trampoline. So this is the all-time high this time around. That's why I'm saying it's a no-brainer buy. It's an absolute no-brainer buy. If you don't buy this one, what are you doing, man? What are you even thinking about? What are you doing? Okay. So I think this one's a no-brainer. Love him or hate him, Donald Trump, he, in my opinion, is very, very beneficial for the stock market and the economy and all of that. Yeah, he's doing some radical plays. I'm not going to say to you guys that I know and understand everything that is happening. I don't. But based on the charts, right? With different, there's been the economy, America, the US, the world has been through different regimes with different presidents, and that there has been different environments to invest in. The trading principles, what I like about them is like within 3 seconds, you can have a pretty good understanding of like roughly what is probably going to happen. Okay. So overall, I feel very, very bullish on the markets. I think we should take our blessings for what it is. Currently, I've heard personally some people have messaged me on Instagram saying like they're a little bit scared to invest at the highs. With Donald Trump, they feel like he's a volatile guy. I would be saying like, dude, like it's about time in the market, and right now this is the best market to be in. Get your money invested, please. All right, go speak to someone, a professional. Hopefully, they know what they're talking about. That's one thing to vet these type of people. But it's my advice: invest the money. Look, into proper assets like S&P 500. It's tried and it's true. You're going to be making money with it. um, you know, Most likely the probabilities are on your side. You hold for 5 or 10 years, like pretty much no one loses in a 10-year hold, especially if you're dollar cost averaging through the hold. If for some whatever reason, like you could get this thing where, you dollar cost for 10 years, let's just draw it at the top here. Imagine your dollar cost, dollar cost, dollar cost, and you get this crazy correction like this, and then your dollar costing all of this, and your dollar cost down, and then in this moment right here, for a split second, your average buy price is up here. That's kind of scary in the moment because you're like, dude, that's a lot of years that you've been dollar costing, and it's for nothing. When that happens, you just gotta remember this is the trampoline. Dollar cost back up until all time high, and then forever past that too. Because if you dollar cost and you go through a full cycle, this is a cycle. This is a stock market cycle. Why would you stop and sell at the bottom of the cycle? For it, that's 3 quarters through the cycle. Wait for the cycle to be fully completed, then judge your portfolio performance. Okay, and you may not even want to judge it there when it returns back to all-time high because it was there at that high previously. Wait for the little rocket ship to take effect, yeah? Wait for the little move, right? Generally speaking, you can kind of get like a measured move. Whatever this move was, you probably get that past the all-time high too. That's like generally speaking, that's average of what happens, okay? So overall, it seems like, there's a reduction in taxes. It's a better environment for companies. So it's easier to make money in this environment for companies. Like I believe, like in the past, when the regime and the environment hasn't been as good as this in the past, what has been the norm. The norm is the market loves to hold above the white dotted line. All right. The white dotted line is the fair price. Right. What like is a fair price. It's a great deal. The green solid line is like, dude, that's once every 5 year type of deal, and it doesn't stay down there long. Look at it. Go back and just count how often, like how long we stay down there. It's weeks, like 1, 2 weeks. That's it. Then once we get down to the green dotted line, that's kind of like once in a generation type of thing. We got that with the COVID. We got that with the 2008 financial crisis. Most of the time, it makes sense that we're going to stay above the white dotted line. And if we've done that in the past when the environment hasn't been as good and we've got this new revolution coming on, which is AI, like all of this was like cloud, internet companies, all of that. Now we've got this next like revolution coming. It makes sense that we hold above the white dotted line. The returns, this is going to be a controversial opinion, right? The returns of the S&P 500 are like 10%. Now, take this with a grain of salt, okay? I'm not saying this is going to happen, but if gun to my head, the returns of the S&P 500 over the next decade are going to be better than 10%. They're going to be better than the average. Why? Because all of the big companies inside of the S&P 500, they're going to make more money. They're going to make more money because of AI. They're going to save on the labor costs. They're going to, be able to serve way more customers because of AI. It makes sense that they're going to become more profitable. So, yeah, I understand statistics. I understand the averages, but we got to look at the data for what the data is and then use our actual investing knowledge to forecast what the data can become. Sometimes the future data is not going to be the same as the historic data, right? That's the past. The past doesn't always repeat. Yeah, it often rhymes. It often rhymes, but it doesn't always repeat, okay? I would be saying back in the day, ages ago, when those, the big companies of the world were just more like physical companies that produce steel and stuff like that. The S&P 500, I believe, you can go fact check me on that. The S&P 500 today is outperforming back then. Why? Because we have tech companies. We have internet-based tech companies. Now, the next 10, 20 years, they're not just internet companies, they're AI internet companies. All right? Does it not make sense? They're probably going to make even more money. They're probably going to make even more money. All right. This, I truly believe this is the golden era to be invested in the stock market. Just invest in the right places, man. Don't invest in some crazy little crypto that's backed by no tech, you know? Every single CEO across the world, what are they talking about? AI, 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 AI. These are the smartest people on the planet. The smartest business people on the planet. They're all saying AI, AI, AI. They're not saying altcoins, altcoins, meme coins, right? Some do like Bitcoin, right? Some like Bitcoin, some like Ethereum, but they're not going down like, they're not opening up Coin Market Cap and scrolling down to the fifth page and be like, bro, this is the next big thing. No one's saying that, right? No one who is intelligent is saying that. That is not a sophisticated way to guarantee your wealth, right? That's just more like a lottery ticket. If you want to gamble, go for it. You want to gamble, go for it. That's not a guaranteed. Like, you want to try to make it practically guaranteed. The goal, in my opinion, is not how to get as rich as fast as possible. It's how to get as rich as fast as possible, practically guaranteed. That's the goal. So it's risk adjusted returns. You have to adjust for the risk. Okay. Or think with risk in mind. All right. I guess that's pretty much everything. I'm going to be buying the dip. You do whatever you want to do. Let's revisit this thing in 5 years' time. I'm pretty sure we'll be able to check this video in 5 years' time. And then anyone who bought, most likely, probably made a pretty good profit. If the market did correct down here, I wouldn't, and we happen to be in this part of the cycle in 5 years' time, we could get one of these fellas. We could get one of them. I'm going to be buying this hard and wait until we get back to the all-time high again. Okay. And then if you dollar cross through the dip, right, to get the average of the market, you have to buy through the average of the highs and you have to buy through the average of the lows and all the way back up. That is the average. If you only buy when the market's pumping, you're not getting the average. You're getting only more of the more expensive prices. If the market does come down as well, what do you do in your life? You sacrifice more. Well, like, what am I going to do? I'm going to sacrifice more. I'm not going to spend as much money. I know it's going to be a temporary opportunity. I'm going to think outside the box. How do I get my hands on way more capital all of a sudden? And I buy this dip bloody damn hard. Okay? Buy it bloody damn hard. As a side note, I run this company called Headstart Capital, right? We have some physical businesses in Indonesia. They are ice cream businesses. What we're trying to do is develop a portfolio of investments, kind of like a holding company like Berkshire Hathaway. Right now, we're focusing on hospitality businesses because they're a great value right now. In the future, we would like to diversify and make our portfolio 50% of the stock market, similar to what I'm doing with eToro right now. You're probably familiar with my eToro portfolio. We buy all the big tech companies. That's the majority, right? That's the thesis. Right now with eToro, we were up just a day ago, a couple of days ago, we were up 30% on the year. We're down 6% now, down to 24%. It makes sense. Our portfolio is quite an aggressive portfolio on eToro. We make more when the market goes up. We make more than the market when the market goes up. But when the market goes down, we make, we actually lose more as well. So either direction, all right, that's that's how the portfolio is designed to behave. Now, the good thing about physical businesses in Indonesia is, they're not on the stock market, so they just tick up like this, right? They tick up nice and easy. Now, imagine you combine that with eToro, which is doing this, right? You smooth out the results, and imagine if we're producing our cash flow from real, actual businesses. When the market dips, when the stock market dips down here, what am I going to do with the cash? What am I going to do with the cash? It's a no-brainer. I'm going to buy the dip that extremely hard. I've got the confidence. I've got the experience. When the market dips, I'm going to go in extremely, extremely hard and do the opposite of what most people do. Everyone else going to be scared, listen to the media articles. Buy, 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 buy. That's what I'll be doing and holding, right? So that's how I'm thinking. I'm just telling you this so you can see my perspective and how I'm thinking about this. Um, because it is a different story when it actually does dip. I see a lot of people, they say, hey, it's really easy. I'm going to buy the dip when it happens. I think around 50% of the people, if educated correctly, if they have the correct education, still only 50% buy the dip, all right? You need the education and you need the experience and you need to be prepared. Study the history. This is where the history is actually good. Study the history. Look at the tariff correction. Look at the Russia correction. Look at the COVID correction. Go through every other correction. Find out what these corrections are. You know, some of them I've already forgot what they were actually driven by at that time. Study them. Okay, so when the next one happens, like, oh, is it worse than this or not? If the answer is not worse than this, something that happened in the past, why are you scared? Why are you scared? Worse things have happened and the market's rebounded. It's really, really weird, but the worse it is, even, like COVID was pretty damn bad, man. Pretty damn scary. A virus going across the world. What's going to happen? A zombie apocalypse? You made more money if you bought the zombies. Buy the zombies, man. All right? Buy the zombies. We find a way to solve this shit. That's what humans do. We're very, very resilient creatures. We always find a way. We always find a way, okay? If you don't believe in humans, all right, stock market is probably not a place for you. Go do something else. Anyway, you got any questions, you know what to do, post them down below. If you made it this far, please do leave a like. If you learned something or I don't know, if you found it entertaining somehow, yeah, please do share this with someone. If they're screaming doomsday at you a million times, go listen to them. Obviously, I spoke about my eToro portfolio in here. It's all 100% transparent. You can go check that out on eToro if you'd like. If not, that's fine. And as well, I've given you a little bit of insight about Headstart Capital, about how I'm thinking. The point is, I don't really care if you invest with me or not. The point is, I honestly, truly want to help you, right? Because like if you're making good returns, that's great, right? I believe if you're making good money, it actually affects your life. It actually increases your happiness, right? And that's what it's all about at the end of the day. I want to see a lot of people that are happy. Go buy the S&P or something similar. Just play it somewhat smart. Use your intelligence. Stay away from the get rich quick stuff like the small little cryptos and all of that. That's my main message. Hopefully that makes sense that I've made my point. Anyway, I'll see you in the next video.